Welcome to Behind the Doors, the podcast where we take you behind the scenes of residential real estate investing. I'm your host, Dan Noma Jr., here with my co-host, Marvin Cruz.
We're here to help you unlock the best strategies and practice for investors. Whether you're just starting out or you're a seasoned pro looking to scale your portfolio.
We've spent decades navigating the ever-changing world of real estate, and now we're sharing everything we've learned to help you succeed.
From off-market deals to cash flow management and everything in between, we'll break it down and bring you actionable insights that can make a real difference in your investments.
So get ready to open the door to new opportunities and take your real estate investing to the next level. Let's dive in. All right. We are here behind the doors. Welcome, Leo Sanchez. I'll introduce you in a minute, but wanted to let everybody know that Marvin is still here, but Marvin's traveling today. So Marvin's out of the office today. We tried to Zoom him in, and we had some technical difficulties with that. So
he's here in spirit.
Marvin will be back next week when we dive into some new topics. But Leo Sanchez, longtime friend, longtime industry veteran, very much knowledge base around Proptech, institutional investing, investing in general, just kind of across the board. And maybe, why don't you share with our crew a little bit about you, like what's new with you and where have you been?
Yeah, absolutely. Thanks, Dan. Thanks for having me. I'm Leo Sanchez, and I've recently joined forces with Dan and Marvin at Easy Street Offers, and I am the Chief Operating Officer, but just by way of introduction, a little bit about myself. I've been in the space for, my whole professional career in residential real estate, but specifically the last about 15 years or so, a little under that, in the SFR institutional realm. And then spent some time in the title world, and then most recently SFR/Proptech. So I was at Zillow Offers as a founding leadership team member there for Zillow Offers, if you remember that.
Oh yeah,
the buying platform.
Yep.
And shortly after that, joined a company called Mynd, a big property manager in the space that recently merged with a company called Roofstock.
Yeah.
So some really large,
big boys,
large companies in our space. Thankful for the time that I had there, but even more excited for the future and what we're building at Easy Street Offers.
Yeah, awesome, man. Well, good. And really, what Marvin and I are trying to do with Behind the Doors is we want to get out to, real estate investors and real estate agents or people just with an interest in real estate kind of in general, and just kind of get behind the doors and kind of explain to them, what a lot of these terms mean. And so, our paths crossed, when you were working at one of these large institutions as an acquisition manager, and I was just your broker, and then that's how we became friends and started working together, and have kept in touch ever since. But I think that's a good place for us to start, is thinking about these large investors, because Marvin and I, we chatted about it a little bit last time, but we didn't get too deep into the weeds, and so maybe I was thinking that for today, and maybe it might take us a couple of episodes really to unpack the SFR investor, right? The large single family rental, in some cases public REIT, the public companies that buy thousands of homes to rent. You're an expert there. And I think that, our audience would love to just dive into that. So when you think about that group, what's the difference between a mom and pop investor, right? Somebody that's maybe owned 10 assets, and one of these large institutional companies? What's the threshold? What makes them special? What makes them different? What is it? That number of doors? Is it their structure? How do you think that they're built?
Yeah, there's a lot to unpack there. That's a big question there, Dan. But it's really not. As you were asking that, my wheels were spinning and really thinking about what the differences are. Ultimately, at the end of the day, the overarching objective is pretty similar. They're looking to acquire assets that, as we know, appreciate over time, and to generate a cash flow for X amount of time. And each strategy at every institution is different in terms of how they're structured, of how they buy them, and how long they plan to hold them. But if we think about the publicly traded REITs, the big boys, if you will, in our space, they're looking to hold those investment properties long term. Yeah. So they're in it for the long game.
Yeah.
And they're looking to print mailbox checks, if you will. It's a term that folks I've heard in the industry when they're referencing mom and pop. So from a high level, the overarching kind of strategy remains the same. Now, when you get behind the scenes, if you will, there are some significant differences. Differences in the sophistication of how they're evaluating assets. Institutions, they have the benefit and luxury, if you will, of having access to large data that not an everyday mom and pop would have access to.
Yeah.
They're evaluating their investments with data, and they're using data to inform those decisions. They do not act even remotely based on emotion. Yeah. The large institutions aren't concerned with the emotions of a typical transaction, but more about the financial metrics and the return on investment, and the numbers don't lie. And so I think when we think from a what the differences are, that's probably one of the largest differences. Yeah. But again, at the end of the day, the overarching is still the same.
Yeah, it's still, it's cash flow and appreciation, right? Those are kind of the two areas that they make money with. And, I think when I think about that too, I think one thing that could be different is that, they're spending other people's money, right? Like not one principal at these companies, the CEO of that organization might have some money into the business, but generally they've raised all the money, right? So they're spending other people's money, which to your point, like on data becomes even more important, right? I've heard one of them say to me once that, it's okay to make decisions when it's your money. But when you're spending other people's money, you better have enough data and information to back it up. And I think that's probably why they dig deep into data, right? Is not only to help them make better buying decisions, but to back up those decisions with their investors. So
yeah, they're in a position where they're transacting in a fiduciary as a role of a fiduciary, right? Yeah. So they have to ensure that they're evaluating everything objectively and making sure that the deals that they're looking at, quote unquote, pencil. Yeah. But yeah, you're exactly right. It's a little different when you're spending your own money versus when you're spending, publicly raised funds. And in some cases, a lot of these institutions are investing on behalf of endowment funds for universities, mm-hmm. or for retirement funds for firefighters and teachers and some of the service providers that are critical to our environment and to our economy, and so I think there's also I want to demystify that there because there's a lot of bad press that comes out about institutions and that Wall Street, if you will, is acquiring a lot of these assets, and ultimately if you start peeling that onion and you start looking behind the
whose money is it?
Behind the door,
right?
It's actually, we can tie a lot of those funds back to grandmothers and grandfathers and folks that have worked their entire career to have a retirement.
Yeah. I mean, I've worked with a group that they were 100% funded by a teachers union out of Chicago. So they had billions of dollars of investable capital that they were using, and I think that kind of leads me to the next question is like, when you're when they aggregate all these properties, right, they're buying thousands of homes. I think the small ones now, 20,000 is a small portfolio. That seems to be like a modest portfolio these days.
It's crazy to think, right? I mean, 15 years ago when you and I were doing this, there probably wasn't one owner that owned more than 1,000 assets.
No. And
how quickly
and
it's
why
evolved.
would you, right? I think we thought they were crazy, but it has become the fastest growing asset class in real estate. And I think there's a few reasons for that, right? Like one is obviously like tenants, there's a demand. Like the tenants that are renting these properties really, really like them. But, I think the difference that someone explained to me was that, you've got single family homes appreciate at a different rate than multifamily properties, right? Multifamily properties trading on a cap rate constantly, right? But the benefit of SFR is that you get to ride the wave of retail appreciation in the market. So now like just the current demand of what those homes are, like we're feeling it right now, right? Where we've got low supply, demand's pretty high, homes are selling at like record prices still. You don't get that in multifamily too much, right? Like I think that's a big difference and a big change.
Very, very unique differentiator. And to your point, SFR being one, the fastest growing asset class in the investment space. Two, it actually, gosh, I lost my train of thought there, is the most, I remember what I was going to say now. It's the most solid fundamentals when you look at investments and you look at all of the metrics behind what makes our residential real estate market in this country strong. It'll remain to be strong because we have a supply demand imbalance, and we also have an inventory. We're short homes.
Yeah.
And regardless of whose number you believe, it's in the millions of homes that this country is behind.
Right.
And so the fundamentals for the future look incredible. And then lastly, you called out a really good point that it's a huge differentiator from SFR, from other asset classes, is it's got just like kind of dual exit option. So you can sell your portfolio if that's what your end strategy is at X number of years to another institution. That's an option. You've got a stabilized portfolio that's producing income. That's a good option.
Right. We see that often.
That's normal, right?
Yeah.
You see them exchanging hands. But on the other hand, you have a retail exit. And to your point, where you can now exit from your investment and sell that property to a regular homeowner, a regular home buyer, someone who's not evaluating that particular asset for cash flow or for a net yield or for a gross yield or whatever financial metric they're trying to achieve. They're actually looking at it to raise their family. They like the school district, they like the area, they like the crime scores are low, and so they're not evaluating properties on a net yield. They do a comparative sales approach, and they're looking at what the property sold in the area. And so, that's when you compare what you can earn in appreciation in a portfolio over time versus what you can earn in home price appreciation for a regular homeowner is a significant difference. And it's a very big difference for multifamily. It's a great point.
Yeah, it makes them nimble, right? And I think
100%.
That's why a lot of people throw investment dollars at them, is they go, well, if the sky turns purple, well, they can sell it on the retail market and probably get much more for it, which kind of leads me to my next question on I get this question a lot, and I just want to hear your answer on it. Is a lot of people ask me, they go, well, what are they going to do with all of these assets once they aggregate them, right? Once they go IPO, turn these companies public, what are they going to do with all of these properties? And I think the fear is that they're going to sell them all at once, right? Just flood the market with a bunch of rental properties. And I'll let you get into why that's probably not likely. But, if someone asks you that question, I'm asking,
Sure.
what are they going to do with them all, right? Because I think people scratch their heads and go, are these just properties gone forever? Like they're just going to be gone? Like what's the deal?
Well, I'll answer that in a couple ways. I'll start by when I got into this industry back when I met you, Dan, almost 15 years ago. I had the privilege of sitting in some of our investor calls, and we were talking to looking to raise some funds from a really large university. They were looking to diversify their endowment investments, and part of a strategy we were kind of flirting with was a rent-to-own type option, and the investors said they weren't interested if it was a rent-to-own this particular endowment, because they're looking for secure funds and that continue to pay year over year. And their point is that you have an appreciating asset, you have a cost basis. We can't turn back the clock to 2011 anymore, to the Great Recession, and buy properties for what you were like. That's
I wish
we would love to, right? You and I both.
Oh yeah.
But that's just not going to, the reality is that's not going to happen again. The cost of construction is skyrocketed and certainly not coming down anytime sooner. The best that we can hope for is prices kind of stabilize. But their point was, you have a cost basis that you can never get again. Why would you ever sell that home? And year over year, as rent increases and values increase, your investment becomes more valuable.
Yeah.
And sure, you could sell it, but then where would you reinvest that money? Yeah. And you couldn't even mirror anything even remotely close to the kind of investment you were getting already. So one, like to demystify that a little bit, is they're not going to sell them because they're earning incredible income. And
the cash flow, right?
Yeah, the cash flow is incredible. And
they're making money on them right now, so why sell it?
Better than any other investment vehicle that they're in.
Yeah.
And so that's a big piece. Also tied to that is sometimes they can't. They've got investment agreements where they've already agreed ahead of time that they're going to hold assets for a fixed period of time. In some cases, 7 years, 10 years, 15 years. But it doesn't mean that they have to sell. It just means they're going to reevaluate what the portfolio looks like. What institutions do is they do something called pruning. And that's a pretty typical term in the SFR space. And much like the term maybe folks are familiar with is, you're pruning kind of the parts of the plant that aren't well anymore or are underproducing, and in real estate terms, it's those properties that are underperforming.
Yeah.
They underwrote a rent for $2,000 and they realized that maybe they were a little too aggressive when they were underwriting, or for whatever reason that didn't come to fruition.
Neighborhood change,
Things
house
happen.
had a fire, right?
Yeah.
Pool's too close to the back door. I mean, I've seen it all, right?
Absolutely.
So,
One thing for sure is this change, right? Everything's evolving and things are changing, and so they're not perfect. They're really good at what they do, but they tend to see like a 3 to 5% prune of their portfolio on an annual basis. That number fluctuates depending on the investor. But what they do is they sell some of those properties because they're not performing at the level that they expected. So you do see some of that. So institutions are selling, and they do, but it's a way to optimize their portfolio. None of the institutions, in fact, even the way they're structured and they're publicly traded and they pay dividends, could totally exit the space if they wanted to.
Yeah.
And that would be crazy anyways. I just don't know why.
Yeah, I mean, and some of them, right, they've gone public, right? So now they're actually public companies. So it's,
that's right.
They've left the private fund world and they're gone into the public fund world. And with that, now think about that. You'd have to go to every shareholder that owns stock in this company and convince them that we've got to sell. And if I was a shareholder, I would say, well, no, you guys all figure out. Yeah, I mean, why, right? Why would I do that? So it's been interesting to watch their stocks too. I mean, they're almost like mutual funds, right? They don't have a lot of fluctuation. There isn't a lot of like volatility in their stock prices. Those that have gone public, they tend to just kind of trade.
That's right.
And once in a while I see $1 here, $1 there, but it never is like a $5, $10 swing. Which is interesting. And I think that's why a lot of people like the consistency of those, because they know they're appreciating assets, they're rented, people need a place to live, they're
Always,
staying in them, and they just work and happen. But how do they, like, these companies are huge, right? Like Invitation Homes today, largest owner of single family homes in the country. What about management? Like that's a world that like I don't have a ton of insight in. I've owned a management company and I've done property management at like 2,000 doors, 3,000 doors, right? When you have 100,000 doors, how do you property manage 100,000 doors on a national level? Like how do you actually even start that process?
Well, it's not easy. It's certainly still not easy, but what makes it possible is this, I had my phone in my pocket, is technology. 2010, we roll out the iPhone, 2008, cloud computing became something that was available at scale. And so what you've seen, just like, technology is disrupted, every industry, and specifically in positive ways and made it more efficient, is that's why it's possible. So most of these firms, almost all of them have internal proprietary technology, and all of them also use off-the-shelf type solutions that are out there. There's a ton of Proptech companies that have made some really cool products in the last decade. But that's how they do it. It's a huge investment. They're managing thousands of homes, and in that particular case, over 100,000 properties. Was never possible when you and I were growing up. No. That was not without technology. You only saw multifamily because it was dense. It was in one location. but cloud computing and technology has really made that possible. It made that, managed portfolios that are scattered site.
Yeah, I'm sure there's probably some of our listeners thinking about like, a landlord, a scary landlord story of like, they walked in and the house was trashed by their tenant, or, tenant had some domestic violence case or something going on. I mean, can you imagine that at 100,000 doors?
Homes, yeah.
Like,
and they still have those problems, by the way.
Yeah, I mean, humans are humans, right? This stuff's going to happen. It does happen. Do you have any sense of like how often that those negative things happen? I mean, it's less than probably most people think. But.
Oh, for sure. I mean, when you're doing that scale, I mean, the number of occurrences are certainly a big number. But when we put things in perspective, to your point, from a percentage perspective, I mean, it's in the 1 to 5% would be high.
Yeah.
Would be a really big number, and I'm encompassing even bad debt, delinquencies, evictions, kind of bucketing all that into one bucket.
Yeah.
But when you think about that, 95% of your tenants, so if you take the inverse,
just pay.
They pay.
They pay.
Generally speaking, people are good people.
Right.
They want to pay their rent on time, and they need shelter. They need a roof over their head for themselves, for their families, for their pets. And so, there's certainly, I have some personally, and I know that you do as well. But those sadly get talking about maybe more and taken out of context sometimes. But
Yeah, I mean, we could probably do a whole episode
we could share some war stories for sure.
Stories of what happens out there in the world of landlord. But I think it's just super interesting that it can be done now at this kind of a scale, right?
It's amazing.
It makes like the idea of owning 1, 2, 5 units sound easy after you hear that people are doing this with they have 100,000 doors. I mean, that's a significant amount of doors. Even just tenancy and leasing. Imagine like what it's like. I mean, you've done it. I've been on the other side of it, but like the leasing of all of these properties, right? I think one of the unique things that we've noticed is that a lot of them don't list their rental properties on the open market, like the MLS. Like they own so many doors. There's got to be a reason why. Just across the board, nobody is putting their properties on the MLS. Like, why do you think that is?
Yeah, I'd say that's most common in the publicly traded REITs. And the reason for that is it's not because they don't want to, participate with other agents and be part of the communities that they own homes in. So I'll tell you that's not the reason why. It's because they want to control the experience. They're, for lack of a better term, control freaks. And when you list a property in MLS, you're inviting another party to represent someone else's behalf, which and for most cases is a good thing. But for an institution, they want to make sure that nothing's lost in translation.
Yeah.
So whatever I told you, you might paraphrase it and leave out some pertinent facts that I didn't relay. And you're signing a contract at the end of the day. A lease agreement minimum is probably on a small one 7 pages. They can grow to 30, 40 pages, right? And so institutions are really mindful. One, they measure their customer satisfaction. They really want to get rid of any kind of perceptions that they might be slumlords, because they're operating these in a professional manner.
Yeah.
And so they just really want to control from end to end the experience, make sure that their potential residents understand the lease that they're getting into. They understand the rules, the restrictions, the covenants that come with their lease. And so that's really the reasoning behind that. When you introduce another party into a lease, again, it just makes it more complex, and to guarantee that some of those messages are being relayed accurately.
Yeah, that makes a lot of sense. So, when you've got maybe an agent or somebody representing a tenant, or even a tenant finds it on Zillow or something like that, and then contacts an agent and goes, "Hey, I want to go see this property." That agent doesn't know a lot about that experience that these companies are trying to make. And I think that gets like washed away in a lot of some of the negative stuff that they do, but some of the positive work that they've done with tenant experience, right? The way that these groups treat their tenants in general,
right,
is significantly better than the normal landlord that I see out there, right, in the world. Because like the normal landlord gets emotional.
Right.
The institution or the big boys, they have a process for everything, right? And if you as a tenant can just get in and be a part of the process, like you can win, right? And I've heard of a lot of people that, live in one company's home in Arizona, move to Texas, and they live in that same company's home again in that market too, right? And I think intertrading across state lines is something that they value, is keeping those tenants long term and doing stuff like that.
Yeah, that's a great example. That's an advantage of when you're with a large organization that owns units in multiple markets and MSAs.
Yeah.
Most of them, if you're a good resident, they want to keep you, and they have plans. They understand that life changes.
I was watching something we were in Miami at that IMN conference, and I was watching the length of tenancy is stretching over 2 years now. So the average tenancy is stretching over 2 years, meaning people are staying beyond just their 1 year lease, right? And they're like, I'm staying over 2, and that's great.
There's some really cool insights as it relates to tenants and the data science behind that, because these big institutions have generally their own data scientists. And you're right. Every time they've published and made some of that available to the public, tenants are staying longer. And a cool fun fact is when a resident has a pet, and the landlord's friendly with that pet, and then the tenancy jumps up to over 3 years average tenancy. Yeah.
So it's almost
they're
better.
flexible, right?
It's almost better to get somebody with a
That's
pet.
right.
Wow.
Yeah, they don't like to uproot their pets more than they don't want to uproot their kids.
I want my tenants to have pet turtles, something simple.
There you go. Something
no dogs.
that doesn't damage the property.
Right. Yeah. Something maybe. All right. Well, let's pivot a little bit, tenants, and think about access to these guys, right? I live here in Scottsdale. I've been working in Scottsdale, Arizona and Nevada with these institutions, and then somewhat on a national level, especially now we're definitely working with them on a national level. But I think it's always just funny that it's almost it's hard to get to know them. It's like a cliquey club. You have to be on the inside to figure out how you're going to sell them houses. Agents ask me all the time. They go, well, I want, how did you do that? I want to do what you do. How do you represent those groups? Right. And I know all the complications of that, but why are they so selective on who they allow to represent them? And then why, as an agent, if you've got a listing, do you have to go through one of their channels to get access to them?
Yeah.
To make an offer to buy it, maybe.
I was on the other side of the fence there, so I think I was maybe one of those cliquey people. You're in the cool kids club. Yeah. I've interacted with tons of brokers in every market that I've been a part of, and been most of the major markets and the country. There's a couple reasons for that. I would tell you from experience. I would get frustrated sometimes working with agents, because we're just speaking two different languages. I mean, I don't have a better way to really drive that home. I'm speaking Spanish, my native language, and they're speaking English, and we're not communicating.
Yeah.
And the difference is the level of sophistication. A real estate agent are incredible at what they do. They add a ton of value to the transaction for consumers. When it comes to an institution, they add value in different ways. And so yourself, you figured it out how you can work with institutions. And I'm sure you've got a lot of best practices and what worked. But as you learned quickly, it was about scale. It wasn't about emotion. It wasn't. We were evaluating homes at the individual level on a yield, and not necessarily off the proximity to the amenities. I mean, that matters, but it's just a different. It's
I think
it's
you
very
said it
different,
perfectly, right? It's translating it.
Right.
So, and that's kind of what I've shared with agents too. I'll say to them, well, look, the technology that we use, or the technology that we've built, translates your property submissions into institutional form so that they can make a strong buying decision. And you got to remember, they're seeing thousands of properties in a day. So if it's not easy to look at, they're not going to look at it, and I think
right.
that's probably why it's there's this barrier of entry to get access.
That's right.
But if you had the right tool, right, then access becomes unlimited, right? They all want it, which brings up a different point on just on market versus off market properties, right? And we actually talked about this morning was, the value of on market versus off market properties. And there's this like stigma out there that, you're going to get a better deal off market. Like, tell me why. Like, why are these guys so interested in off market or pre-MLS inventory?
Sure. I think that's never ranked truer than the market we're in today. We're in a very supply constrained market, and it's not unique to any specific MSA. The only difference is some of them are more restricted in terms of inventory. But almost, I guess I shouldn't say every, 99%, all the markets that you and I know of, there's a supply issue. There's not enough homes for sale. And so when you're able to offer something that's off the market, something that's exclusive, that's not available to the masses, immediately that's attractive to an institutional buyer, or really take the institutional out to any buyer, right?
Yeah.
To any investor.
Yeah, retail, whatever. Yeah.
You're getting access to something that not everybody has access to. So that alone is a significant benefit. And oftentimes when you're getting something off market as well, the seller is generally a little more flexible, and that's a very general statement. But they're off market for a reason, because it works for their particular scenario, whatever kind of situation they have at their home, and so that naturally they're a little more flexible, right? Yeah. They know that perhaps not always, but in some cases they're leaving some money on the table if they went to the masses. But for their life circumstances, the convenience is worth the trade-off.
Yeah.
And that's not for everybody. And you and I know that, but it is for probably 1 to 3 people out of every 10. Yeah. And that's enough when you think about that.
Yeah, I remember like doing a study of a portfolio that we aggregated for one of our clients, and we studied, whether it was on or off market, and that comparison was to like current market value, and did we get a better deal or not? And I think what we learned through that is it wasn't necessarily we got a better deal. It was that we didn't compete with a retail buyer and potentially lose the deal, right? We got the deal, which was like the benefit of practicing off market or pre-MLS, so to speak. And so I think that was an interesting find. It was just that, thinking about, it's not that there's just like blasting better deals out there. I mean, in some cases, like, a guy sends us a house and it's been burned down or whatever, and you might get a slamming deal on that property.
That's the needle in the haystack, though, right? It's not the...
Yeah, but the norm isn't just like a huge discount from market is what you're buying at off market. You're just buying it. You get the ability to
access,
buy
you
it,
get to see
right?
it.
Yeah, so it's just a different than what people think, right?
That's right.
When they hear off market, I think people think discount is like the two immediate things,
right?
And it's like, no, it is partially. I mean, yeah, you might save a couple bucks in fees or something like that, but the reality is what you're getting is just straight access and the ability to buy it,
right,
and without it having to be shopped to the world. And that access is invaluable in a lot of cases, especially when 100%. You're scaling, right? These guys are looking to buy thousands of portfolios or thousands of doors. It's hard, and to buy thousands of properties. It's really hard. And so any access to supply, any competitive advantage helps a ton, for sure.
And I believe it's an advantage in any market. You and I've seen a couple different cycles in our tenure. We got some gray hairs now. I think we got 2
Marvin
decades
and I
in this
talked about
industry.
Last week how old we were. We're like, geez, we are dating. I was like telling everybody, I was like, God, I've been at this for 22 years. This is crazy. But
we're the same.
We're
We're
old
right
dogs
21.
now.
I'm like, wow.
We're old dogs now. Yeah, we're old at this. Well, let's wrap up with like a couple like fundamental things, right? So I think there's a misconception too that that real estate investors, large scale real estate investors, they inspect, but they inspect differently. And I think we've seen everything from like formal inspection all the way down to just like verification of the renovation budget level inspections. But they always inspect, right? Like I've never met one that didn't actually inspect. So, in general, like what if you were to sell a property to an institution, or you were to agent on the other side of that deal, what would the inspection process look like? That and maybe contracts. Like do they use their own contract, or are they using like a state issued contract? Like what's your experience been with both of those?
Yeah, I would say we'll tackle the inspection first.
Yeah.
one, they inspect. I mean, there's a lot of, you and I know a ton of investors out there that don't inspect, or they want to shorten the inspection period. Some institutions recognize that in order to be competitive, they've got to do that. But you're never going to see an institution waive an inspection. That's just not. How can you advertise yourself or say that you're a fiduciary on behalf of wherever your investment dollars are coming from, right?
Yep.
And you're not doing that due diligence. And so, one, you'll never see an institution not do an inspection. Two, they're pretty standard to whatever the standards are of that market. They adopt quickly to what's going to help them get properties. They don't like to disrupt whatever the typical timeframes are. In this market, it's probably 7 to 10 days. We're sitting here in Arizona. It's probably somewhere around that in most markets. But again, some institutions, if they got to move fast, they can move fast. But these are large organizations, and generally speaking, their inspectors are in-house crews, and so they got to dispatch work, and they've got a pipeline of work that's in front of it, and they got to fit it into the schedule. And so they can move quickly, but they're always gonna take it, and they generally kind of conform to whatever the standards are in that market.
Yeah, less thrashy for who they're working with, right? So whether that's the broker in the market or the listing agent on the other side. So yeah, I've seen state issue contracts too, and inspections, kind of a normal inspection. So I do get that question a lot where people will go, well, you got to put up a hard earnest deposit and you don't get an inspection. Well, I can't buy it then. I mean, that's my barrier of entry. So if you want to sell houses to the big boys, which has value because they tend to pay a little bit more, closer to retail value for their homes.
And they close.
And they close, right? Then you got to let them inspect, and they're going to give you a state issue contract. You're not going to see a one-page wholesale contract or something like that used in these cases. So, or
even, I've seen the real estate community, conversations that I've had recently, and with you, we were at a conference recently, is that question came up. I think a lot of iBuyers use their own contract, and wholesaling is taken over by storm.
Yep.
I mean, every time I look at my social media feed or someone knows I'm real estate, they want to sell me a property, and they're a wholesaler and they took a 48-hour course and they're ready to conquer the world.
Right.
And they use their own contracts, right?
Yep.
But that's not the case for these large institutions. They comply. They're highly regulated. They stay with the state contracts and they want to inspect. And you're going to get a professional inspection.
Yeah. I think that's one of the things I respect so much about this industry is just that it goes back to real estate fundamentals, right? This is not gimmicky real estate. There's not we're not holding title on properties and doing weird, things. And there's a place for all of that. I think that's great. You guys do that. It's fine. But what's nice is to just have fundamental business practice, and fundamental business is clean. Everybody knows what's going on. Both parties are happy at the end of the day. They got what they wanted, money and then the asset. So I don't know. To me, that's always been one of the things that attracted me to it was just the fact that it went back to real estate fundamentals. Does the math work? Yes. Okay, I'll buy it. We're going to work out these terms, and then we're going to write this contract that's, on a real form and a real legal contract. And if we don't abide by that contract, we're going to have a problem. But if we do, we're both going to be happy at the end of the day. And it's just do that and you're fine, And
I'll tell you that the institutions share that sentiment. It's a mutual feeling. Having worked for institutions and worked with most of them, with them or for them, the companies I was at, and most of the ones that I know, they won't take an assignment contract because it gets pretty hairy and things aren't fully transparent. And in me, as as a leader of an acquisition department, the last thing I'd ever want to have to explain on a settlement statement is why 6 people are getting paid when we acquired it. We're acquiring it for a teacher's fund, and it's why did 6 other people get paid on this contract? Right. And so we, to your point, it's mutual. They want to keep things, above board, and not that those deals aren't. I think that there's wholesalers that do a good job and help some folks out. But for an institution, it's too hairy. They're not interested in those.
Yeah, too many things to worry about.
Too many things to explain.
Yeah. Well, man, thank you. I think we've got a whole nother kind of episode that we can
Probably
talk
got a
about.
couple more.
We've got a couple more conversations we can have. We're just scratching the surface, but yeah, thanks for your time. We'll let these guys break for now, and then we'll get back to them soon.
Sounds good.
All right,
Appreciate you
thanks.
for having me.
We'll see Marvin maybe too. We miss you, Marv. Thanks for tuning in to another episode of Behind the Doors. We hope you found today's insights valuable for your real estate investing journey.
Remember, real estate success doesn't happen overnight, but with the right tools and strategies, you can build long-term wealth and create passive income.
If you enjoyed the show, be sure to subscribe, leave us a review, and share it with others who are passionate about real estate investing.
Don't forget to follow us on social media for more tips and exclusive content.
Until next time, keep unlocking new opportunities, and we'll see you on the next episode of Behind the Doors.